So allow me just to introduce to capital allowances. I remember I was able to share certain documents which discusses about the investment allowances. And basically I'm just having, I was not able to type my short notes, which I was able to look on them today based on the few changes which might have already been affected due to the aspects of the Finance Act. Finance Act, they are the ones which normally affect the capital allowances and so on, and the income tax, because the new proposals are normally put in place, and you cannot be able to avoid the circumstances. Now, when you look on the capital allowances, we are saying they are granted instead of depreciation as a compensation for the loss of value of assets repeatedly used in business to generate taxable income. And when you look on the aspect of the capital allowances, you will be able to understand it is the only deductions from the loss of value of assets, which is acceptable by the Income Tax Act. What you have to be looking at, because here we are looking on an aspect of the loss of value of an asset. Basically, what is very important is to know that the assets, based on how they normally lose the value, it is different from what you normally do when you are computing the financial reportings or when you're doing the financial management, and so on and so forth. So they normally include one. We normally have investment deductions. So the capital allowances are grouped into different stages. One, we can talk about the investment deductions. Secondly, we discuss about the industriability deductions, that is IBD. And when you are doing the IBD, you can see on my notes I'm saying, always when you are doing the IBD, you can be able to adjust for the period in which the asset was put into use. So, for example, you may find we purchased a certain assets, for example, at the beginning of the year or at a certain period within the year. For example, when you're doing the investment deductions, there is no any adjustments which are going to be made. But when you are doing the industriability deductions, you're going to be apportioning for the period. Kama asset imewekwa into use within a specific period, tuseme tulianza kutumia an asset by October and our year runs from January to December, it's very important to know that the IBD which you're supposed to be calculating should be for 3 months and so on and so forth. Now, also we discussed about the wear and tear allowances. And when you're looking on the capital allowances, you'll be able to realize at your stage. Don't concentrate on the farm works deduction, shipping. They are not part and parcel. They are not applicable at your stage. But I'll just be able to introduce to you because you'll be able to learn them at advanced level. Now, when you look on the investment, you'll be able to know that when you are dealing with the investment deductions, we are saying it is normally granted on assets only once. Manufacturing, by the way, this should be the manufacturing assets only once. Currently at the rate of 50% in the first year of use and 25% in the subsequent year. Your information imefika hapo. You don't need to be looking for further information at your stage. So in this case, you can be able to see what are some of the assets or what are these assets which normally qualifies for ID. You'll be able to realize that we normally, such assets normally include the cost of the factory building, other structures associated with it, such as a borehole, drainage system, sewerage system, perimeter walls, loading bay, we have parking zones, and then also we have the driveways. When you look on the processing machinery and other machineries which are basically associated with it, some of these machineries we might be discussing about the water pump, we have the packaging machines, we have the conveyor belts, we have air cleaners, silencer, waste treatment plants, workshop machineries, generator, among other assets. And these are the assets which normally qualify for ID. I have said there is an information which we have skipped, where it is discussing about the period of 2003. That information will be able to use it when we advance to the other level. Now, but here I am able to state very clearly that effective 2020, the ID is granted the rate of 50%. of the qualifying cost in the first year of use, and the residue of 25% per annum on reducing balance basis. Secondly, you just need to understand that land does not qualify for any capital allowance. Land will not be able to qualify for any capital allowance. Number three, we normally discuss about an aspect of calculating the 10% test. And these basically normally apply to the cost of the showrooms, retail shops, office administration blocks. We have the caretaker's dwelling house, among other assets. But these are the assets which are supposed to be calculating the 10% test. What does it mean? It means that if, for example, the 10%, the proportion which we are going to be computing by taking the sum for the showroom, retail shop, offices, administration blocks, and the caretaker dwelling house exceeds 10%, then these assets are going to be deducted from the factory building and they are going to be granted IBD. But if, for example, the rate for the computation of the 10% test is below the 10%, it means that if it is below the 10%, they are not good. They are going to be qualifying for. They're going to be qualifying for. They're going to be qualifying for the investment deductions. Now, from that aspect, it is very important to understand there is no any point where you're going to be telling me that our land will be able to qualify for the land that will be able to qualify for capital allowances. We say it does not qualify for any capital allowances. Now, number two, we are discussing about the industrial building deductions. Industrial building deductions, and under the investment building deductions, what we are supposed to be knowing is that it is a bit different from the one that we have discussed up there, where we are discussing of investment deductions, and it is normally granted to non-manufacturing. It means that the other one, it is normally granted to manufacturing. So in this case, we are discussing it is normally granted to non-manufacturing buildings on reducing balance basis, currently at the rate of 10% per annum, effective 2020. Don't even look for the before. That information I have said mostly applicable under the advanced level. These assets normally include, we normally have warehouses, staff clinic, staff quarters, canteen, we have gym, offices, administration blocks, we have the showrooms, right? We have shops, social halls, among other assets. Now, when you're looking on the this aspect of that information is not important for you. You see here, we are saying the cost of blah, blah, that is not important. Now, when you look on the third category of capital allowance, we are discussing about the wear and tear allowances. And under the wear and tear allowance, here, we are discussing of our concepts whereby we are going to be looking on manufacturing machineries and equipments. And when we discuss about the wear and tear, I remember before, kuna mtu anaweza kuwa alisoma ile syllabus ya kitabu, where we used to have more classes. I remember there before we used to have 4 classes. We used to have class 1, 2, 3, and 4. But under the review in 2020, the classes were grouped into 2, right? So in this case, we had some assets. So these assets which qualify for class 1 to when you look on the classes, we say the assets which used to qualify for class 1 to 3, they were merged together and they qualify, now they qualify for class 1 at the rate of 25% per annum on a reducing balance basis. Now, these assets normally include, we remember there before we used to talk about the self-propelling equipments that basically moves on earth. And in this case, we are talking about caterpillar, tractor, bulldozers, combined, it should be the combined harvester, forklifts, lorries below and up 3 tons. We talk about the pickup, saloon car, tuk-tuk, motorbikes, limo, aircraft, delivery van, and staff buses. But you remember very well, and you need just to be understanding on this case of restriction, that when, for example, we are dealing with saloon cars, they are normally restricted to 3 million Kenya shillings. For the saloon cars which are exceeding, the purchase price is exceeding 3 million. For example, if you have purchased a car for 40 million, the one that you are going to be qualifying for capital allowances will only be 3 million. Now, under this restriction, if the actual cost of a saloon car is 4 million, you're just going to be writing on your computation of the capital allowances that what we are dealing with is the restriction of that asset to 3 million Kenya shillings. That is how you're going to be calculating. You are going to be taking 25% of 3 million, but not 4 million. You get your WTA for the saloon car. Now, number two, and the assets which normally qualify for the WTA, we are discussing about the office electronic equipments. And electronic equipments, these are the things which normally defines an office. They normally include computers, a photocopier, printer, ATR, scanner, calculator, duplicating machines, electronic paper shredder. You have things which used to have special classes like websites and softwares. So that is where you see when we are doing our other topics, you could be able to realize that the office electronic equipments, right? We are granting all of them the 25% rate. And you could be able to realize that these assets, which you are granting 25%, we are just including together with the other self-propelling assets. So it means when, for example, the analysis and review are being done, we used to, the review was able to combine class 1 to 3 to class 1. Now, when we discuss class 2, at the rate of 10% per annum, reduce the balance basis, it normally includes other assets used in the business, and these assets which are used in business but do not qualify for WTA class 1. E.g., here we normally discuss about the future furniture and fittings, partitions, fax machines, neon sign. We have neon sign. We have office carpets. We have things like wheelbarrows, bicycles. We have things like generators. We have curtains, water tank. Because you remember the one that is qualified for ID, it is water pump, right? Here we are discussing about the water tank. We have the loose tools, which include the spanners, pliers, and hammers. We have things like utensils. But hii kitu inakuanga rahisi sana. Any asset which does not qualify for class 1 will qualify for class 2. That is why we normally call it is a duplicating, or it is not a duplicating, but it's a dumping site for the capital allowances. Point to note, the WTA is granted on reduced balance basis. ID is granted at the rate of 50% of the qualifying costs in the first year, and 25% of subsequent years. IBD is granted on the rate of 10% of reduced balance basis, right? IBD for showroom, retail shops, caretakers house, and admin blocks are granted the rate of 25% on a reduced balance basis. My biggest question and worry will be, can we be able to do any question right now? Because already I cannot even access the questions. Anyone who has a different document for questions? Don't know what happened now. Kuna mtu akona document.
Yes, I have hard copy. You can share the year. Maybe I can share in the group. I have hard copies.
Can you be able to share on WhatsApp group?
Okay, let me share.
The PDF.
The PDF. Okay. I can use a phone scanner.
Can you try? We see what we can do right now.
Yeah, so maybe you share the year, or I just share randomly.
You can give us within, let me see what we can do here. 1 minute. But I wanted to start from 2023 April. 2023 April, do you have?
2022 April.
2023 April.
Okay, let me check. Yeah. I have April 2023.
Kindly share with us. Someone to read, please. Nobody is willing to read.
Okay, Parking Limited, a large manufacturing company, has provided you with the following statement of profit or loss for the year ended 31st December 2021. Gross profit 32,000. General expenses 1,400. Loan repayment 1,600. Director's fee 4,200. VAT paid 4,200. Sorry, 2,700. Depreciation 5,700. Salaries and wages 2,400. Interest expense 4,200. Installment tax paid 600. Dividends paid 1,005. Repairs and maintenance 2,250. Okay, on the additional information, on 1st January 2021, Parking Limited purchased an industrial building from Samba Limited, a contractor, for 200 million shillings. The following details were availed that comprise the total purchase price for the following for the industrial building. Land 22,000, demolitions of old building site 10,000, labor quarters 60,000, factory building 90,000, perimeter wall 5,000, drainage and sewer system 13,000, totaling to 200,000. 2. The factory building above houses a warehouse costing 7 million shillings, administration block costing 7 million, and showroom at a cost of 4 million. Third, Parking Limited purchased and installed a processing machinery in the factory at a cost of 40 million shillings on 2nd January 2021 and started manufacturing leather products. The cost of processing machinery included workshop machine and a boiler at a cost of 5 million and 6 million, respectively. Scroll up, please. Okay. 4. The following additional assets were acquired during the year ended 31st December 2021. On 5th January 2021, computers were acquired on hire purchase at 620,000 shillings. Hire purchase interest included was 140,000 shillings. Acquired furniture and other machines at 720,000 and 968,000 respectively. On 15th March 2021, Parking Limited bought a pickup for 2.25 million, a motorcycle for 190,000, a water pump for 48,000, and 2 delivery trucks for 5 million each. 2 saloon cars were purchased at 3.6 million each in April 2021. In October 2021, 1 saloon car was involved in an accident, and the insurance company paid 2 million as compensation. In November 2021, the pickup vehicle was traded in with a new delivery van valued at 3 million. The pickup had a value of 1.6 million at the time of the trade-in. 5. Interest expense included higher purchase interest for the computers 140,000, interest on overdue loan 200,000, provision for interest on a loan to be obtained to expand the business, 752,000. Interest on unpaid tax, 448,000. 6. Gross profit included anticipated foreign exchange gain of 2 million and a reduction in general budgets of 620,000 shillings. Required, Pakim Limited investments allowance for the year ended 31st December 2021. Ascertain the taxable profit or loss for the year. Explain the tax treatment of tax losses.
Thank you so much. You can see how the question is being drafted there. The examiner is asking a very simple questions. Can you be able to calculate the capital allowances? And also, can you be in a position to show us whether we can be in a position to ascertain the taxable profit or losses for the year? From there, we are discussing about the last question being to explain the tax treatment of losses in your country. We will be able to do that. But the most important thing here, it is to compute the capital allowances. That is the first step that we are supposed to be having, the computation of the capital allowances. And when you are going to be computing your capital allowance, it's very clear to understand where the assets normally qualify. Where do these assets you are dealing with? Which stage do they normally qualify for? So in that regard, that is why we were able to look on, do we have assets which qualify for the investment deductions? Yeah, we are just going to be grouping them together to calculate the investment deductions. Secondly, we have to be looking on the assets provided by the examiner here, which qualify for the IBD. And we remember we said we always adjust for the period of which the assets were being acquired. Thirdly, we are discussing about the computation of the WTA, and we have said under this computation of the WTA, it is very important. It is very important to know the classes in which the assets normally qualify. For better understanding, the question, someone who has switched on the video should be switching it off, please. We have said the first thing that based on the requirement we have to be doing, let us calculate the investment deductions. So when you're calculating the investment deductions, this is what we're supposed to be doing. Let me see. There is someone who is switching on the video without knowing. I'm sure of that. Welcome, Clement. So let me first look on the network will be stabilized and you'll be able to see everything there. So let us start by the computation of the ID. Here we are discussing about investment deductions. And remember very well, you are doing a question for August 2022, question number 4B. It should be question number 4B. Now, the format which you're supposed to be using is very clear. You're going to be having the nature of assets here. Nature of assets, right? We are going to be taking the qualifying costs. What is our qualifying costs? We are going now to be taking our rates, right? The rate we are going to be putting them there. Then we are going to be having our ID amounts. We're going to be having our ID amount there. So as per the provision in the question, it's very important to know. Someone is greeting me. Yvonne, we have said it is August 2022. Question number 4B. Already we have the questions. So we are hoping we are following. So we are going to be starting with the information provided here by the examiner. So Where should we start? Let us start with the additional information number 1. On January 2021, Pakim Limited purchased an industrial building from Samba Limited, a contractor for 200 million. So the following details were availed that comprise the total purchase price for the industrial building. Land, we said it doesn't qualify. But here we have the demolition. Demolition of that old house basically is qualifying here. So in this case, what is the qualifying cost? The qualifying cost here will be 10%. Granted 50%. So 50% of this, I know it is 5,000. We have reduced our shillings to thousands. Secondly, I can see we have labor quarters. They normally qualify for IBD. We have something called factory building there. We have factory buildings. So under the factory buildings, we look on the qualified cost for the factory building. In this case, we have a qualifying cost for 9,000. Granted 50%, right? So 90% of 50%, I think we're going to be getting 45,000. We're going to be getting 45,000. The next thing I can see there, and qualify for the ID, we have the perimeter walls. We have perimeter walls. So perimeter walls, we have the qualifying cost is 5,000. Granted 50%, right? This translates to 2,500. Then after the perimeter walls, we have the drainage and sewerage system. Drainage and sewerage. So the drainage and the sewerage systems, the qualifying cost will be 13,000. 50% is our rates. So this translates to 6,500. Now from there, we look on any other information provided there. So in this case, there might be an information which is going to be affecting the qualifying cost for the factory building. And that is what I can be able to see under information number 2, where we are being told the factory building above houses a warehouse costing 7 million, admin block costing 7 million, and a showroom of 4 million. In this case, you normally try to do your 10% test. So 10% test, we take the sum of these houses. So we have 7,000 plus 7,000 plus 4,000. Then you divide by the total value of the factory building. In this case, we talk about 9,000. Then you multiply by 100%. You multiply by 100%. How much is our 10% test? How much is our 10% test? So in this case, you just take your calculator here. So it will be 18,000. It will be 18,000. 18,000 divided by 90,000, right? This translates to 10%. And in this case, you say restricts. So when you're going to be restricting, it means we have to be deducting that cost from the factory building, and we are going to be granting them IBD. So if, for example, you take 9,000 minus 18,000, you're going to be getting a difference of 72,000. So it means this one is going to be changing to that 6,000. Nafikiri hapo tumeelewana. Then in note number 3, we are being told the Pakim Limited purchased and installed a processing machinery in the factory at a cost of 40 million. They're being told on 2nd January 2021 and started manufacturing leather products. So the cost of the processing include the workshop machine and the boiler, costing 5 and 6 million respectively. If you can be able to, or you want to get more marks, you can be able just to come and you tell me, wacha tuweke tu boiler. Boiler yenyewe tumeambiwa it is costing how much? 6,000. 50%. This translates to 3,000. We have things like we are being told it is normally workshop. Let me just put here, because they might be in other questions inaweza kuwa peke yake. Workshop machine. So the workshop machine qualifies, or the qualifying cost is 5,000, 50%, translating to 2,500. Now from there, we have things like the balance now for the processing machinery. What will be the balance for this processing machine? It will be, if you take 40,000 minus 11, you'll be able to get to 9,000. Nimeweka tu hivi for better understanding. Hatungepaswa kuzitoanisha, but for getting more marks, you can just separate them. Divide by 2 here, getting 14,500 is the same thing. Then from there, I can see note number 4. We have been told the following additional assets were acquired during the year ended at 4 December 2021. Computers, WTA. Number 2, we have been acquired furniture and machines, 720. Those are WTAs. On 15 March 2021, Pakim Limited bought a pickup of 2.25 million. All of that, you can see they qualify for WTA. 2 saloon cars were purchased at 3.6 million. Those are WTAs. Where are we? I'm looking just for whether we have any additional information at Tuna. So tukienda pale juu kabisa, what do we have? Kuna kitu tunasahau somewhere, and the one that I'm looking for. Who saw water pump somewhere? Other machines, pickup, motor vehicle, water pump. Yes, we have water pump here. There is a water pump which was purchased. So how much is the water pump? You'll be able to realize the qualified cost for that water pump is 48, 50%. Here we put 24. What is the total ID now? Total. Total ID claims. You do your summation. So the first one is 5,000, followed by 36,000, plus 2,500, plus 6,500, plus 3,000, plus 2,500, plus 14,500, plus 24. You are getting 70,000, 024. That is the total for the ID. Now, after that, you go to the IBD. Still, the formats look similar, but here we have the nature of assets. You have the nature of assets there. Qualifying costs, right? You have the qualifying cost. If the residue brought down are there, residue brought down, if they're in existence, you put them there. We have IBD rates. Then we have the IBD amount. Then we have the residue carried down. We have the residue carried down. Kuna asset tulisema zina qualify for the IBD, right? One will be, as per the information provided in the question, we have things like warehouse. We have warehouse, yeah. In this case, we talk about 7,000, right? But also the period for this. This warehouse has been in existence for the whole year. So 7,000, the rate will be 10%. Here will be 700, right? What will be the residue carried down? If, for example, we had the residue brought down, we get the residue brought down minus the IBD amount to get the residue carried down. But in this case, because we don't have, take your qualifying cost, 57,000 minus 700, getting 6,300. Next, we have admin block. You have admin block for the same amount, 7,000 there. We don't have this, 10%, getting 700, 6,300. From there, we have things like showroom. So the showroom, 4,000 dash 10%, 400, 3,600. That's 600 there. Then I can be able to see, do we have any other assets? Yes, I remember on additional information number 1, we forgot labor quarters. Labor quarters. So the labor quarters amounts to 60,000. 60,000 dash 10%, 6,000, correct? Then here we have 54,000. 54,000. Now, in this case, there is no any other asset which is qualifying for the ID, but what we just need to understand, if, for example, you could have an asset which was just being put into use during the year, for example, because this, you know, this is the IBD for the whole year, then you can be able to apportion it for months. In case we come across that problems, we can be able to check on it. So here we talk about the IBD claims. The IBD claims will be 1,400, 1,800. Here should be 7,800. It should be 7,800. Then from there, let us calculate the WTA. Let us calculate the WTA. WTA is very simple here. It is very simple. Very simple. So when you're calculating the WTA, we just need to take our assets. For example, you say class 1, the rate is 25%. Then we have class 2 at the rate of 10%. Correct? Straight away. So in this case, we normally start with the written down values at start. At the beginning of the year, if you had the written down values, you normally put them there. Then the assets which we acquired during the year, they are normally called additions. Right? They are normally called additions. The assets which you have purchased during the year, they are additions. So in this case, you're going to be starting with the good. So you're going to be starting with the some additions here. Pakim Limited, all that we are able to take care of. But in note number 4, we are being told we have some assets which you are able to buy during the year. So on 5th January, computers were acquired on a high of 620. The higher purchase interest included was 140. We don't need to include. So what is the cost of the computers? It will be 620 minus 140. 620 minus 140 is how much? Getting 480. Unaiweka hapo. 480, correct? Then we have things like acquiring furniture and other machines, right? So here we have furniture. So how much of the furniture? We have been told that the furniture which was acquired amounted to 720. Unaiweka hapa class 2. 720. We have other machines. Qualify for class 2. Hatujui ni machines aina gani. So other machines amounted to 968. Then we have things like on 15 March 2021, Pakim Limited bought a pickup. So the pickup normally qualifies for class 1 at the rate of 22. The qualifying cost is 2250, right? Then there is an information provided there. We are being told, what are they saying? On 15th, the Pakim Limited bought a pickup of that, a motor vehicle. So took on a motor vehicle. Motor vehicle. So how much is the motor vehicle? The motor vehicle is 190. Right? The motor vehicle is 190. A water pump, 2 delivery trucks. Delivery trucks. How much is the delivery trucks? 5 million. Okay. Oh, motorcycle is sawa too. Vehicle too. Motorcycle. Thank you. So delivery trucks each at 5 million. It means here we put 10,000. Dash there. We have things like 2 saloon cars, right? So the saloon cars which were being given here were purchased at 3.6 million each in April. So saloon cars purchased. How much is our saloon car? We said these saloon cars we are going to be restricting. Right? So you can see each was costing 3,600,000, but in our case, we are supposed to be restricting to 3 million. So in this case here, we are putting 6 million, and then hapa tunasema we restricted. 6 million restriction, because there were 2 saloon cars. In October 2021, one saloon car was involved in an accident, and the insurance company was able to compensate for certain amount there. We shall be able to look on that. From there, we have been told there, in November 2021, the pickup vehicle was traded in with a new delivery van for 3 million, right? The pickup paid a value of 1.6 at the time of the trading. So tuko na gari mpya hapa inaitwa delivery van. Delivery van for 3 million. Delivery van for 3 million. Now, remember we have a disposal here, right? We have some disposals. So how much was the disposal? How much are the disposal values?
1.6.
Just wrap at one point, we have disposal. So we have a disposal for the saloon car. The disposal of the saloon car. So we have been told the saloon car was compensated for a certain amount. In this case, we have been told the value which was compensated is 2,000. We divide it by, right? It is 2,000. I said very well, the saloon car, if the value exceeds 3 million, they are normally restricted. That is an act. We cannot be able to change it. Saloon car ikipitisha 3 million, you restrict it to 3 million. But if it is below, ingekuwa 2,800, or 2.8 million, we could not be able to restrict them. But ours has already exceeded 3 million. That is what our case is different from the one that from what you are seeing there. So in that case, just understand you have to restrict. You have to restrict. Now from there, okay. Okay, so in this case, remember we have things like we have things like who? We are discussing about the disposals. So the disposal that we have, one is for what? Saloon car. There is a formula I just looking for so that I can be able to show you how it is normally done. That is a formula, just 1 minute. So the formula for the disposal normally looks like this, very simple. We normally say, when you're disposing that assets, right, it will be the sales proceeds, correct? It is very simple, it will be the sales proceeds. For ours, you are able to get 2 million, you divide by that 600, which is the cost of that saloon car. Then you multiply by the value that you have restricted, and the value for the restriction is 3 million, right? The value for the restriction is 3 million. 3 million restriction. So in this case, it will be 2 million. In our case, it's 2,000 divided by that 600 times 3,000, getting 16,000. Oh, sorry, 1667. 1667. That is what we're supposed to be getting there. Then there was also a car which was disposed. There was a pickup. So let us look on that information. So the pickup had a value of 1,600. We also subtract there. So what is important now, let me just wrap this. I know we will not be able to forget 7,800. Calculate the written down value. This will be the qualifying costs. So we do our summations now. So in this case, it will be 720 plus 968, getting 1,688. Then the first one will be how much? The first one will be 480 plus 2250 plus 190 plus 10,000 plus 9,000 there plus, sorry, minus 1,667 minus 1,600. We are getting something closer to 18,623. 18,623 there. Then from that point, there is somewhere where we have messed. This should be a big figure. Because I think the computers were how much? Let me see whether already been told. The computers to hire is 620. Or it is okay. So then we less our WTA. So the WTA will be how much? You take the rates, you multiply by the qualifying cost. For example, this will be 168.8. 168.8. Then the first one will be 18,623 times 0.25, getting 4655.75. Then what you're supposed to be getting down here is normally called the written down value at the ends. What will be the written down value at the ends? So 18,623 minus my answer here, getting 13,967.25, then 1688 minus 168.8. We are getting 1519, 1519.2. 1519.2. Any question? Any question at that point? Any question? Just raise your question, please. So everything is clear. That is what the silence means. Then from there now, we can be able to compute what is needed there. So in this case, that is part 1. 8 marks already sorted. Then now, when I look on part 2, the examiner is asking you to compute, ascertain the taxable profit or loss for the year. And in this case, when they are telling me to ascertain, what you're supposed now to be remembering is these your capital allowances. You know, these values you have gotten here and these ones. You see these two. You're going to be doing the summation of the two. The summation of the two. So in this case, allow me just to calculate the last parts. The second part, sorry, of the question. And this is the area that I know Sheila and the team, you have just been practicing throughout the computation of the taxable profits by doing your tax investigations. So this guy is normally called Pakim, right? Pakim Limited. Na utaandika na small letters kama mimi, unaandika na capital letters. Unaandika title zako na capital letters. So it is normally called the Pakim Limited. We are doing, which year are we doing the question? So in this case, we have been doing a question for 2021. So hapo nakuja wanasema 2021 adjusted taxable income computation. Taxable income computation. So in this case here, you just put the columns for Kenya shillings, hapo Kenya shillings, na hapo Kenya shillings. That doesn't reduce to thousands of shillings. Namna hiyo. Then we start with our reported profits. We start with our reported profit or loss. So when I look on the question here, the reported, the net profit for the year was 5165. We said we normally add disallowable expenses. What is our disallowable expenses? Very simple. So to get our disallowable expenses, we start with the additional informations. We'll be able to realize this information we'll start from the additional number 5. The interest and expense included the higher purchase interest for the computers, which is an allowable expense. We have the interest on overdue loan. The interest for the overdue. We normally have the interest on loan, which is allowable, but this is an overdue. So in this case, we talk about 200 here. This is a disallowable expense. Secondly, we have been told there is a provision for the interest. We said only the provision which is allowable, it is for the specific. So provision on interests. So the provision on these interests for the interest on loan is 752 disallowable. The other thing is the interest on unpaid tax disallowable. Interest on unpaid tax amounted to 448. From there, let us now look for additional number 6. We are being told by this examiner that the gross profit included anticipated foreign exchange gain, right, of 2 million and a reduction in general bad debts of reduction in general bad debts than untaxable income. The anticipated, we shall be able to deduct that information later on. Achana nayo kwanza, turudi pale juu tuangalie the disallowable expenses. One, when I look on the less expenses, one was the general expense allowable, but we have the loan repayment disallowable. So how much is our loan repayment? We have been told it amounts to 1.6. Our case is 1,600. Director's fees allowable. We have the VAT paid. It's allowable. So the VAT paid amounts to 2,700. The other thing that we can be able to see there is depreciation. Depreciation is disallowable, amounts to 5,700. We have other things like salaries and wages allowable, donations, right, to a political party. We said the only donation will be to the charitable organizations. This is 780. Interest expense allowable. We have things like installment tax paid, disallowable. So installment tax paid amounts to how much? The installment tax paid amounts to 600. 600, right? 600. Do you have anything else? installment tax paid. We have things like dividends paid. Ukiangalia venye mna calculating the payment of the dividends ukiwa na Mr. Choi, the dividends are normally paid after you realize your profit after taxes. So they are not part and parcel of your expenses. So this translates to 1,005. 1,005 there. Nothing else we should be putting up there. What now we shall be concentrating on is we less non-taxable incomes. We divide or allowable expenses. So in this case, non-taxable incomes stroke allowable expenses, you can start with your capital allowances. And you are able to calculate your IB. You got 70,024. You have things like IBD. Total, you are able to get 7,800. Then we have WTA, which you are able to get it. For class 1, it was 46, 55 point something, which is 75, plus 168.8. How much is this? So the total will be 46, 55.75 plus 168.8, which is 4824.55. Then after that, now you can be able to go to that note number 6, which you are being told very clearly that there was anticipated foreign exchange gain. Anticipated forex. In this case, unasema this was unrealized. So unrealized was amounted to 2,000. Then we have another thing here, which is called reduction in general bad debts. So the reduction, you know, is those are non-taxable incomes amounted to 620. So let me start by adding up there. 200 plus 752 plus 448 plus 1,600 plus 2,700 plus something called 5,700 plus 780 plus 600 plus 1,005, getting 13,785. Then down here we have 7024 plus 7,800 plus 4824.55 plus 2620, amounting to 85,268.55. What is your tax adjusted taxable income? So the adjusted taxable income will be 5,165 plus 13,785 minus answer. How much are we getting here? 85. That one should be okay. Yes, we are having a loss. This should be a loss here. So it will be 66,318.55. This one is a loss. That one is a loss. And then that is the reason is why examiner amekuuliza, explain the tax treatments of tax losses. How do you normally treat your tax losses? How do you normally treat our tax losses? It will be very simple. So to treat your tax losses will be very easy, very simple here. You say, or you tell the examiner this, you can be able to tell your examiner this. Number 3, the tax losses in Kenya The tax losses in Kenya are carried forward as allowable deductions. They are normally carried forward as allowable deductions against future incomes arising from the same source. Such losses are carried forward. Indefinitely. They are carried forward indefinitely. Effective 1st January 2022. They are carried forward indefinitely from that period. They are normally carried forward indefinitely from 1st January 2022. Any question? Any question? Any question, please?
Come again on a question. Come again on 10% test, kindly.
Continue.
Just explain to me on 10% test. If it is higher than 10%, we consider, and if it is below?
If it is below, hatungezitoa pale kwa factory billing, zingekaa tu hapo.
Okay.
Hatungezitoa. We should not have deducted if it was below. If it was below, zingekaa hapo. So I want you to do April 2022, question 5C. I need more questions coming from you. From the same field, we have a question. We have December 2021, and those who don't do assignments, I don't know mnasomanga sangapi. December 2021, question 4C. You have a good question there for the investment allowances. We also have another question for the same from you have a question on September 2021. It should be question number 4C. There are very many. Hakuna mwaka yuko. We have another question they tested on May. You have May 2021. May 2021, question number 4B. Question number 4B there. It should be November 2020. November 2020. The November 2020 should be question number 4C. Wacha tufikisha hapo. It should be question number 4C. And these questions are supposed to be done in channel to our WhatsApp group. Just make mistakes now. Don't wait to make mistakes during the exam time. Just make those mistakes now. I will just be able to correct you on the right time, which is now. So I just want to stop at that point and thank you guys for being patient. In case there is any question from this, which is going to be challenging, based on now, I will be able to see your interpretations of the information. We shall be in our next class, we will be able to do that question, which might be challenging to you. We do it. Or we do more than 2 questions during that time. I think we should be having time, not as per today. Then we'll be able to look on the VAT later on. We shall be able to check on the VAT later on. Tomorrow, for those who are doing management accounting, very good. I'll just be able to, I hope I will be able to arrive as early as 8.